Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. Markets surge to critical highs, but a dangerous complacency sets in. While indices soar on rate cut hopes, market breadth is collapsing is a brutal reality check just one hawkish comment away. Second, Palantir CEO versus the Big Short's Michael Burry, the war that triggered a 16% stock plunge. Why is a CEO publicly attacking one of Wall Street's most famous bears? And with the stock at 233 times earnings, is Burry right about an impending AI bubble collapse? Finally, Amazon's warehouse demand plunges to a 7-year low, masking a new logistics crisis. This isn't just a real estate story. It's a critical signal that could make the Fed's inflation fight impossible and trigger the next surge in shipping costs for everyone. Warning, the market's on edge today as optimism over a potential December Fed rate cut has already been priced in, leaving little room for error, with major indices like the Nasdaq surging 4.9% just last week. We're at a critical juncture where any hawkish surprise could trigger a swift downturn. Listen up, this is not the time to sit back. The S&P 500 closed Friday at 6,849.09, up a modest 0.5%, while the Dow gained 0.6% to 47,716.42. But don't let these gains fool you underneath. The market's showing signs of stress. Fewer than 22% of major tech stocks posted positive returns for November despite a tech rally, indicating a dangerous market breadth deterioration. This divergence between index strength and broader market weakness suggests we're at a critical inflection point. Let's break it down. The Fed's anticipated rate cut has already been factored into the market, with expectations jumping from below 40% to nearly 87% for a December cut. This repricing was driven by dovish comments from key Fed officials like New York Fed President John Williams, who hinted at further policy easing due to labor market concerns. But here's the catch. If upcoming economic data disappoints or if the Fed leans hawkish, we could see a rapid unwinding of positions, especially in high valuation growth stocks. The VIX, our fear gauge, fell to 17.19, down from 23.43 earlier, signaling complacency. Yet, with the S&P 500 just 42 points shy of its record high, the risk of a pullback is palpable. And remember, the Fed's decision on December 10th will be pivotal, miss this, and you might regret it. Sector-wise, tech remains the star, with the Nasdaq's weekly surge driven by giants like Alphabet, Tesla, and Broadcom. But dig deeper, and you'll find Nvidia, despite beating earnings, fell over 6% last week due to customer concentration risks. Meanwhile, healthcare is emerging as a defensive play, highlighted by Eli Lilly hitting a $1 trillion market cap, thanks to blockbuster drug sales. Look at the financials too. JP Morgan's call for rate cuts reflects confidence in economic resilience, pushing the sector higher. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Short term, 1 to 2 weeks, assuming the Fed maintains its current path and December rate cut expectations hold, act now by trimming tech holdings by 8 to 12%. Specifically, cut Nvidia and Meta, which are vulnerable to any negative surprises. Reallocate these funds into defensive sectors like healthcare, VHT, and financials, XLF, which offer a safer haven amidst potential volatility. Medium term, 1 to 3 months. If the Nasdaq breaks below 23,000 before the December Fed meeting, overweight financials by 3 to 5%. These stocks benefit from rate cuts as they stabilize net interest margins and boost lending volumes. Consider adding JP Morgan or Bank of America, which are positioned to capitalize on a dovish Fed stance. Defensive divided by risk watch. Should the 10-year Treasury yield spike above 4.5%, or if the Fed signals a hawkish pause, implement a defensive strategy by increasing cash holdings to 15 to 20% and hedging against tech volatility with inverse ETFs like PSQ. For those more advanced, consider option strategies to protect against downside risk. Hedge options. Advanced traders should look at buying QQQ put options to protect against tech declines. Intermediate investors might opt for sector rotation into defensive ETFs like XLU or XLP. For the basics, simply bolster your cash reserves. Time's ticking. Remember, the Fed's December meeting could be a game changer. A hawkish surprise could send shockwaves through the market, so stay alert and ready to pivot. Now, let's dive deep into today's critical market dynamics and prepare for what's ahead. A CEO just went on the record calling a legendary investor's bet against his company Bats crazy. That CEO is Alex Karp of Palantir, and the investor is Michael Burry, the man made famous by The Big Short. This is the front line of a new war on Wall Street. Burry is betting big against Palantir, and in response, Karp appeared on television twice in 1 week, accusing the famed short seller of market manipulation and calling his actions egregious. This public feud is the backdrop for Palantir's worst month in 2 years. The stock plummeted 16% in November, caught in a vicious sell-off of AI stocks as investors panic over sky-high valuations. A while back, we flagged the first cracks on the hardware side, Dell and HPE tumbling after Morgan Stanley's sweeping downgrades. Those early warning shots are now ricocheting into software. The AI sell-off isn't just about servers anymore. It's hitting narrative-driven names like Palantir. So what's driving this is not just Palantir. We're seeing a clear split in the market. You know, the initial phase of the AI rally where almost any stock with AI in its description went up seems to be over. Now, investors are getting more discerning. They are moving their money from so-called pure play AI stocks like Palantir, which are seen as higher risk, to the tech giants like Microsoft or Google. This is a classic flight to safety. These larger companies have massive diversified balance sheets, which makes them feel like a safer bet in uncertain times. The relative performance between these two groups of stocks is actually becoming a leading indicator for risk appetite across the entire tech sector. We previously analysed Morgan Stanley's warning about an unprecedented pricing supercycle in data centres and the profit squeeze from spiking memory costs. Remember, they cut Dell's FY27 gross margin outlook by 220 basis points. Even though Palantir doesn't build boxes, investors connect the dots. If infrastructure gets more expensive and hardware profits are under pressure, enterprises may slow or scrutinize AI spend, pulling capital toward the giants and away from pure plays. And the warnings are getting louder. Jefferies analysts called Palantir's valuation extreme, while Deutsche Bank admitted it was very difficult to wrap our heads around. Let's start with a single statistic that might just change your entire perspective on this company. Even after its steep drop, Palantir trades at 233 times forward earnings. For comparison, AI darling Nvidia trades at 38 times and Alphabet at 30. The key here is the word forward. This isn't about how much money the company made in the past. It's a bet on how much it's going to make in the future. A high forward P divided by E ratio means investors are expecting explosive, almost unbelievable earnings growth down the road. So Palantir's stock price isn't just a reflection of its current business. It's a highly sensitive barometer of market hopes for the entire enterprise AI industry. And here's where it gets interesting. It means a stock like Palantir could signal a broader sector-wide reality check on AI spending long before it shows up in the earnings of other companies. But that's not the whole picture. The real turning point is that this brutal sell-off came right after Palantir crushed its third quarter earnings, posting its second straight billion-dollar revenue quarter. Despite the strong performance and new contracts with firms like PwC, the market punished the stock. So why the disconnect? However, if you zoom out, you'll see another layer of strategy at play. Palantir's explicit strategy is to serve Western democracies and their allies. This is what some analysts call a geopolitical moat. In an era of increasing US-China tech decoupling, Palantir is betting that success will depend as much on geopolitical alignment and trust as on technology. The new contract with PwC, a major firm in the UK, isn't just another commercial win. It's a sign of success in building this allied network. This strategy could insulate Palantir from both Chinese rivals and even from US tech giants who aim to remain politically neutral. For Chinese companies, this trend highlights a shifting global landscape where market access and competition are increasingly influenced by geopolitical factors, not just commercial ones. The core conflict is clear: a defiant CEO versus Wall Street skepticism and one of the world's most famous bears. Karp, for his part, is doubling down, telling shareholders the company is delivering venture capital level returns to everyday people. Now, get this. CEO Alex Karp's unusually aggressive campaign against short sellers isn't just emotional, it's a signal. It suggests that Palantir's success is more dependent on its story, its narrative, than its peers. This is what's known as a story stock. The risk for a story stock is its potential fragility. A shift in the narrative, not just a change in the financial numbers, can trigger a massive price change. Karp knows he needs to control the story, which is why he's fighting so hard in public. He ended his recent earnings call with a message for his critics. His words, not ours. Please turn on the conventional television and see how unhappy those that didn't invest in us are. Enjoy, get some popcorn. They're crying. So, what's next? The key focal point to watch is whether this AI market bifurcation continues. Keep an eye on the performance gap between pure play AI stocks like Palantir and the diversified tech giants. If that gap widens, it could signal more pain for high growth tech stocks and a broader turn toward caution in the market. Another thing to watch is Palantir's ability to secure more major government and allied commercial contracts. Each new win will be seen as proof that its geopolitical moat strategy is working. Also watch whether the hardware margin squeeze we discussed, memory prices, data center cost, inflation, and any fresh downgrades eases or worsens. If it worsens, it likely reinforces the flight to safety and keeps pressure on high multiple AI software names like Palantir. We were just talking about how high-flying tech narratives are meeting a reality check. Now, let's shift our focus to the physical world, where another tech giant, Amazon, is sending a powerful signal its demand for giant warehouses just hit a 7-year low. This year, the e-commerce titan has occupied just 61 logistics properties, a staggering drop from as many as 300 in recent years. And this isn't just a random pullback. It's a deliberate strategy that some experts are calling the Amazon shrink to win signal. The key is that Amazon is acting as a bellwether for the entire e-commerce industry, signaling that the future isn't about having the most square footage, but about having the times right times square footage. They are actively leasing smaller, more efficient warehouses closer to customers, a pivot that prioritizes automation and rapid delivery speed over simply storing goods in bulk. This isn't just an Amazon story. It's a signal of a massive cooldown in the industrial real estate sector that rode the pandemic era boom. New construction has plummeted, falling from a peak of 330 million square feet in 2023 to just 48 million in the first half of this year. Rent increases are slowing, and in some oversupplied markets, they're even falling. This cooldown is directly linked to a major macroeconomic trend, the end of the great inventory destocking cycle. For the past couple of years, companies overordered during the pandemic and then spent time selling off that excess inventory, which helped bring down the prices of many goods we buy. The slowdown in warehouse demand suggests this process is nearly finished. And that's crucial because if warehouse demand and rents start to bottom out, it could establish a floor for goods prices, making that last mile of the inflation fight much more difficult for the Federal Reserve. This is where the situation takes a more complex turn. The game has fundamentally changed. The focus has shifted from sheer scale to efficiency, power, and location. As one global real estate investment manager put it, where distance once drove advantage, closeness now creates it. Believe it or not, we're now seeing the emergence of what's called a power premium in the warehouse market. It's a new class of asset. So the thing is, this mirrors what has already happened in the data center industry, where access to the electrical grid isn't just a feature, it's the main selling point. Research from CBRE shows that in some major data center markets, prices for large deployments have jumped as much as 19% simply due to power constraints. We are now seeing this logic bleed into logistics. This creates a sharp divide where modern power advantage warehouses can command higher rents while older legacy properties risk becoming obsolete because they can't support the robots and automation that define modern e-commerce. And while the warehouse market rebalances, a new crisis is brewing. Prologis, the world's largest logistics real estate company, is now forecasting that shrinking trucking capacity will drive double-digit rate hikes in 2026, amplifying the value of well-located real estate. This all connects to another seismic shift, reshoring. As federal policies push manufacturing back to the US, research from Hines predicts this trend alone could increase overall warehouse demand by roughly 35% over the next 5 years. There's a very tight correlation where a new factory gets built, a new warehouse is needed nearby. This is creating a structural inland demand base for logistics space that is completely independent of the traditional coastal ports that serve e-commerce imports. For audiences in China, this is a trend to watch, as it represents a long-term strategic reconfiguration of global supply chains that could alter the traditional map of manufacturing and logistics, creating new economic winners in the American heartland. So, what's next? The race for sheer square footage is officially over. The new battle is for power, proximity, and a defense against a looming logistics crunch that could make getting goods to your door more expensive than ever. Keep an eye on two things: industrial vacancy rates and trucking freight rates. If vacancy rates stabilise and start to fall, it confirms that the inventory destocking is over and goods inflation might be harder to tame. And as those trucking rates begin to climb, it will put even more pressure on companies to find those perfectly located, high-power warehouses to keep their costs and the price you pay under control.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.